2024 has been an impressive year for the market this far, and when we look at a heat map of the S&P 500, pretty much everywhere we look, we see a lot of green. Look at technology, a lot of green, communication services, consumer defensive, healthcare. If we come down here, we can see financials have performed extremely well. We can see the same is true for industrials, energy, basic material, and even utilities. But here's the problem. There is one area that has really lagged behind the rest of the market, and that is real estate. If we zoom in over here, we can see real estate has performed pretty poorly over the past year and really over the past couple of years. There's pretty much been a huge sell-off across the entire sector. Now, when I personally see a huge sell-off in the entire market or even just a specific sector, that actually gets me really excited. Now, why is this? Well, what this means is the market is not selling off these equities intelligently. For example, if there's a really high quality company in real estate and also a very poor company in real estate and they both sell off 10%, that means the market is not selling off these equities intelligently, and it creates opportunities to buy quality companies at good prices. And I think that's exactly what's happened in the real estate market, and more specifically, I think that is what has happened with one of my favorite real estate investment trusts, VICI Properties, stock ticker VICI, currently trading at $28.71 per share. We can see over the past year, they're down around 7.18%, and if we look at them year to date, now down close to around 10%. Now, trading at this current price gives them a very nice starting dividend yield. If we come over here, we can see it's sitting at about 5.78%. So in this video, I do want to look at the dividend metrics for this company, but I also want to look closely at what makes this company such a solid REIT in my opinion. And then of course, we're going to be jumping into my REIT valuation spreadsheet to see if we can find the intrinsic value. And like always, you can download any of my spreadsheets on tickerdata.com. So let's go ahead and start jumping into it. Now, like I've already touched on, pretty poor performance over the past year and year to date. They've been lagging behind the S&P 500 by quite a bit. Now, the starting dividend yield is now pretty close to 6%, so this is a pretty big dividend payer that we're talking about. But what's really impressive is, again, we're talking about a real estate investment trust, but if you look at the dividend growth rates for this company, it's pretty impressive over the past 3 and 5 years. 3-year dividend CAGR of about 8.29 and 5-year of 7.76%. That's really good dividend growth for a company that is a real estate investment trust. Now, this company overall is still relatively new to the market, so if we look at the dividend history, we can see they have been increasing dividends since they've been publicly traded. In fact, it's gone from around 16 cents per share all the way up to now around 42 cents per share every single quarter, so we can see good history of increasing those dividend payments. Now, when we talk about dividend safety for a real estate investment trust, a lot of people get confused because they look at the payout ratio, but that doesn't give us an accurate representation of the safety of the dividend payouts for a REIT. What we need to be looking at is the AFFO payout ratio, and that stands for adjusted funds from operations. This is going to give us an accurate representation of the safety of those dividend payments. And we can see for VICI, it's sitting at about 75 to 74%. In my opinion, that's pretty healthy. And we also have to keep in mind, REITs are required by law to pay out 90% of their earnings in the form of dividends. So if we just look at the payout ratio again, it's not going to give us an accurate representation. This is the best way to look at it. So far, there's a lot to like about this company from a dividend perspective. Really nice starting dividend yield. The dividend payments look safe. They have a history of increasing dividend payments and a pretty good dividend growth rate for a real estate investment trust. All these dividend metrics make it very attractive, but here's what I really love about the company. If we jump over to the website, scroll down, we can see VICI Properties is an S&P 500 experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations by owning 3 of the most iconic entertainment facilities on the Las Vegas Strip. So they own some of the highest quality real estate, in my opinion, in the United States, and really other real estate investment trusts can't really replicate the type of real estate that VICI Property owns. If we jump over to the investor's presentation, we can see VICI Properties is a massive hub for tourists. In 2023, they had over 41 million visitors. We can also see in 2023, they had 8.9 billion in gross gaming revenue, which was actually a 7.2% increase. So this is actually growing pretty rapidly. So not only from a gaming perspective, but we're seeing more and more sports teams move to Las Vegas. And keep in mind, we just saw the 2024 NFL Super Bowl hosted in Las Vegas. And in 2028, we're actually going to see the NCAA Final Four hosted there as well. So from a location perspective, this is a great start. This is another reason I really like this REIT. But there's some other key things that make me even more attracted to it. If we jump over to the 5th slide, here's what I want to point out. 100% of VICI's tenants operate under triple net leases. Now, what exactly does this mean? Well, a triple net lease is an agreement on a property where the tenant promises to pay all expenses, including real estate taxes, building insurance, and maintenance. So what exactly does this do for VICI? Well, it makes the cash flows they receive from the tenant very predictable because they know they don't have to worry about those expenses, and it also makes it quite a bit less risky. So for me, I love investing into REITs that operate with triple net leases. Now, if we come over here to the right, we can see some of the top tenants and the percent of annualized cash rent. And you can see they're pretty top heavy, but here's the thing. Some people would argue this is a pretty big risk for the company, which is fair. I can see why they'd say that, but when you look at these companies, these are pretty high quality companies, and again, they're in the heart of the Las Vegas Strip, an area that is absolutely exploding. So we can see Caesars makes up 39% of annualized cash rent for this company, and MGM Resorts around 35%, and then we have the Venetian at around 9%. These are by far the biggest percent of annualized cash rent for this company, and these companies are pretty strong. Now if we keep going and scroll down to the 6th slide, again, there's quite a bit more here that I like. First off, come down here, look at 2020 rent collection. Like we know, 2020 was a very difficult year for REITs because they had a lot of trouble collecting all of their rent. But we can see VICI Properties, in the midst of a pandemic, was able to collect 100% of their rent. So if you're worried about how this company would perform when markets are in turmoil, we can see in 2020, this wasn't really a problem for them whatsoever. And again, something else I like about this company is the predictability. Look at the remaining lease terms. On average, around 42 years. Now, this obviously also depends on tenant renewal options, but again, with these tenants being in the heart of Las Vegas, I think it's pretty likely they renew. If we keep scrolling down and look at the 7th slide, here's something else I really love about this company. One of the major concerns a lot of investors have right now, obviously, is inflation. Inflation is affecting all of us. Whether you invest in real estate, the stock market, or some other alternative assets, inflation is going to affect you, and it affects us in our day-to-day life. And a lot of the times when I buy higher yielding stocks, inflation is one of my biggest concerns because I know if that company can increase their dividends at a rate above inflation, then they're technically paying out less in dividends every single year. So when I think about a real estate investment trust, I want to make sure they're increasing their rent above the rate of inflation every single year, and this is something VICI has taken into account when creating their contracts. We can see for 2024, 50% of VICI's rent roll has CPI-linked escalation. So basically that's saying their rent will increase along with inflation. That's a good sign. Now I'd like to be it a little bit higher, but we can see this is something VICI has done. By 2035, this number will be 96%. So for me, as someone who owns VICI properties, I really don't have to be very concerned with inflation over the next 10 to 15 years when I own this company. I know if inflation goes up, then the amount of rent that this company will collect will also go up. And now finally, if I scroll down to the 8th slide, something we've already touched on a little bit. The dividend growth from this company has been very good, and we can also get some more insights from this company. We can see they're targeting a 75% AFFO payout ratio. Now, if you remember, back on Seeking Alpha, if we jump over to the dividend safety tab and scroll down, we can see that's pretty much exactly what they're at, AFFO payout ratio of 75.06%. So it is always encouraging to see what they're targeting to actually happen. That gives me confidence in management. But here's what's really impressive. If we compare VICI's dividend growth over the past few years to their peers, we can see they're outpacing them by quite a bit. We can see Realty Income coming in at about 2.7%, GLPI, which is another gaming REIT, at about 3.2%. We can see ADC, another REIT that I like, about 6.1%. But VICI is sitting at 7.9%. So they're paying big dividends, the dividend is growing, and those dividends are safe. That is a phenomenal combination. Now, before we jump into the valuation for this company, there is a bit of news that we need to touch on that recently came out. We can see subsequent to the first quarter's end, VICI provided a loan to one of their portfolio's tenants, the Venetian, for extensive upgrades to its property. And this is something they put out a news release on. We can see on May 1st, 2024, VICI agreed to provide capital to the Venetian Resort Las Vegas for extensive reinvestment projects through VICI's partner property growth fund strategy. Now, what does this mean? Well, basically, VICI has agreed to provide up to $700 million of financing through the Venetian capital investment, comprised of $400 million to be drawn in 2024 and an incremental $300 million that the Venetian Resort will have the option, but not the obligation to draw in whole or in part until November 1st of 2026. We can also see that this $400 million loan will have an annual yield of around 7.25%. So overall, in my opinion, that seems like a pretty decent yield for the capital they're providing. Now again, before we touch on the valuation, there's one more thing I have to point out. If we jump over to my stock screener spreadsheet, again, you can download this on tickerdata.com at the link in the description, but come up here and plug in VICI and hit enter. We can see all this data will automatically load in. Now the metric I want to point out is shares outstanding. We can see shares outstanding has grown pretty dramatically, especially in the past few years alone. Now why is this? This is typically not something that's good for a company for the most part. Because if shares outstanding is increasing and you're a shareholder, that basically means you're being diluted. We can see in 2014, shares outstanding was around 360 million, and in 2023, it's now over 1 billion. If we look at 2021, it's sitting at about 564 million, and again, already sitting over 1 billion. So that's pretty dramatic increases in the past couple of years. So what's the reason behind this? Why has this been increasing so much over the past couple of years? Well, like I mentioned earlier, REITs are required by law to pay out 90% of their earnings in the form of dividends, which means they don't have a lot of capital left over to reinvest back into the business, which means really they can focus on growth through two different ways. they can take out debt or they can issue new shares. Now we have to keep in mind, ever since 2020, interest rates have increased pretty significantly, and that makes debt quite a bit more expensive. So what a lot of REITs have decided to do, like VICI Properties, like Realty Income, is start issuing new shares. They've decided this is a better way at current interest rates to grow rather than taking on new debt. And so we can see that's exactly what VICI has decided to do. So is this a concern for me as an investor? I would say yes, a little bit, but overall we have to keep in mind the reason they're doing this is because they don't want to take on high interest debt right now. So there is strategy behind this. Now let's answer the golden question. Is VICI trading at a good value at $28.71? And again, let's go ahead and jump over to my REIT valuation spreadsheet. You can see I've already plugged in VICI Properties, so all this data has automatically loaded in. If we come over here, we can see they have a beta sitting at 0.89, so you should see a little less volatility than that of the market. Now the first valuation I'm going to look at is going to be our AFFO multiples valuation. And basically what this does is it values a company based on how other companies that are similar in structure are trading, looking at their price to AFFO multiple. So you can see our 4 comparable companies right here. We're taking the stock price, dividing by AFFO to get the price to AFFO multiple. And we can see for these comparable companies, the average price to AFFO is sitting at 17.31. Now if we look at VICI's price to AFFO, it's only sitting at 12.76. So it looks like this company's trading at quite a bit of a discount compared to these comparables. In fact, if you apply the same price to AFFO to VICI, we come to an intrinsic value of $38.95. And keep in mind, they're currently trading at about $28.71. So again, like I mentioned earlier, these REITs are not selling off intelligently, which provides opportunities for us as investors. If we jump over to our dividend discount model, let's go ahead and zoom out a little bit. Basically, this values a company based on how much they're paying out in dividends and how much that dividend is increasing over time. So we can see the yearly dividend payouts for this company over the last few years, and the dividend growth rates, they've been pretty solid. Like I mentioned earlier, pretty safe dividends, but an average growth rate of about 7.27% over the past 4 years. Moving forward, if I project a dividend growth rate of 3.75%, which some could argue is even a little bit conservative, with a discount rate of 8%, we come to a dividend discount model price per share of $40.52, which is quite a bit higher than that current trading price. So if we jump over to our output tab, we can see the 2 valuations we use in this scenario, AFFO multiples and dividend discount model. And when we average them together, we come to an intrinsic value of $39.74. It's a pretty big difference from the current trading price. It's about 27 to 28% difference. So with a 10% margin of safety, the acceptable buy price comes in at $35.76, and with a 20% margin of safety, $31.79, so we are getting a buy signal. Now we have to keep in mind, why are REITs down in the first place? Well, again, it goes back to interest rates. With interest rates high, investors don't want to take on as much risk when they can get risk-free money. So REITs have really sold off because of that. So at this point, we are really in a waiting game with REITs. I wouldn't expect the share price to go up quite a bit until we have rate cuts, but here's the good news. During this time, we can collect a very nice 5.78% dividend yield and start building up our position. I don't think this dividend is at risk whatsoever. So I'm completely happy to collect my dividends, reinvest it back into this position while the company is trading at a nice value. But go ahead and let me know in the comments down below what you think of this REIT, what you think of VICI Properties, whether you agree or disagree. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.